Hi, in this video, we'll further discuss the relationship between the price and the earnings here. Okay, so from the previous video, we already knew that the price of a stock is calculated as the EPS of the first period divided by its required return plus the present value of growth opportunities here. So let's rearrange this and see what comes up. Okay, so first we need to divide both sides by the P0 here. So we get the EPS 1, okay, divided by R, and then divided by P0 plus present value of growth opportunities divided by 0, and that P0, okay? And then let's multiply both sides with the required return, R here, okay? So the R here is going to be EPS of 1 divided by P0 plus the R times the present value of growth opportunities divided by P0. Okay, and then we move this thing to the left hand side, and then we switch both sides a little bit. So we keep EPS 1 over P0 on the left hand side, and we have R minus R times the present value of growth opportunities divided by P0 here. Okay, and then we flip the both sides, okay, by dividing, using 1 divided by both sides. So we have P0 over EPS here, which is 1 divided by R minus R times PVGO divided by P0 here. Or we can simplify this a little bit by saying it's P0 divided by the EPS1 is 1, and then R times 1 minus present value of growth opportunities divided by P0 here. Okay, so let's take a look at the left hand side here. This is sometimes called the P ratio, or the price to earnings ratio. Okay, so it is a commonly used indicator of a firm's earnings abilities and its growth abilities here. Okay, so let's take a look at how is this thing calculated and what it is dependent on. So obviously there is PVGO over here. Okay, so look at where the PVGO is. Okay, it's on this this bit here. So we have a negative sign here, but it's also on the denominator here. Okay, so with higher PVGO, this thing becomes smaller, but then 1 divided by the whole thing becomes bigger. So that means with higher growth opportunities, your P ratio will go up. Okay, so sometimes a firm with very high growth opportunities is called the growth firm or the growth stock. Okay, the growth stocks, and they will have very high P ratios. Okay, and then what if the present value of growth opportunities is very low, and sometimes they're called the value stocks, and their P ratio would be lower. Okay, so why do we invest in either type of these stocks? So for growth stocks, obviously we are buying or investing in its growth in the future. Okay, but what about value stocks? So these stocks are mostly very big companies, very mature companies that pay out a steady stream of dividends. So that dividend is what we're going for. Okay, so a P ratio here is a simple metric or a simple indicator of a firm being a growth firm or a value firm. But that specific number is dependent on the specific industry. So there is no universal P ratio that could be used in this whole market. Okay, it depends on which industry that we're talking about. So there could be an average or a different average from industry to industry. So we need to be very specific on that and then make judgments about whether it's a growth stock or it's a value stock. Okay, and then I'll see you in the next video.